Hi everybody, my name's Griffin Bridgers. This video is the first in a series where we're going to explore the income tax rules that apply to certain types of trusts that are known as grantor trusts. I'll talk about the scope of this video and series on the next slide, but for now, as always, this presentation is not intended to substitute for legal or tax advice and is being provided for educational purposes only. So that being said, this is the first part of a broader series on the grantor trust tax rules, and I have created this series, as with most of my content, with an intended audience of professionals who assist with wealth transfers. It could be anybody among attorneys, CPAs, trust officers, financial advisors, so on and so forth. This is not intended for individuals needing assistance with their personal planning. So that being said, if you're within the intended audience, these videos will supplement articles that will be published on my newsletter at griffinbridgers.substack.com. And with that being said, many videos and portions of articles will be behind a paywall for newsletter subscribers. And if there's material you want to access, I would encourage you to only subscribe if you are a wealth transfer professional within the intended audience. So with that being said, we're going to start out with a broader look at the purpose of the grantor trust rules. Now, I'm oversimplifying the history here for purposes of flow, but generally, the grantor trust rules came about as an addition under the Internal Revenue Code of 1954, which predated our current Internal Revenue Code of 1986. There's some real distinctions between the two, but the biggest one relates to the trust and individual tax brackets. When we compare the tax brackets that apply to single filers versus those that apply to trusts, it used to be the case that those tax brackets were identical for individuals and trusts under the Internal Revenue Code of 1954. That allowed somebody to essentially ride up the tax brackets twice by splitting income between themselves and a trust over which they'd retain certain control so as to lower their effective income tax rate. However, this advantage was largely done away with in the Internal Revenue Code of 1986, where the tax brackets for trusts were changed so that they were no longer the same as the individual brackets. They were changed to be compressed significantly compared to individuals. So, in this context, originally, the grantor trust rules were designed to prevent or at least limit the opportunities to shift income to a trust to lower your tax bill. However, we now find ourselves in a weird situation where the compression of the tax brackets has largely done away with any advantage you would have gained from doing so anyway. So we now find ourselves in the opposite situation where in the modern planning environment, usually grantor trusts, when successfully deployed, are going to lead to a lower effective income tax rate than if income was successfully shifted to a trust. Now, there's lots of nuances that come with that, one being tax reimbursement that we're not going to get into here, which doesn't always mean that somebody's going to be better off using a grantor trust when compared to a trust that is taxed on its own income, as we'll look at towards the end of this presentation. But here's a quick comparison of individual and trust tax brackets in 2025. As you can see, for trust, you only get the 10%, 24%, 35%, and 37% brackets, whereas individuals have broader brackets and broader ranges in each bracket. So, where a single filer would only hit the top tax rate of 37% when their income exceeds $626,350. For a trust, that top tax rate is hit once the trust's income exceeds $15,650. So it's a boon to use grantor trust and use these broad brackets where applicable, depending on the individual's personal income that's already taxable to them independent of the trust. So, as we go through this series, we're going to take deeper dives into specific code sections and generally looking at how the grantor trust rules. But generally what they're going to do is cause some other taxpayer other than the trust to be the quote-unquote deemed owner of the trust's taxable income for income tax purposes only. Now that's not always all trust taxable income. To get there, as we're going to see, we have to look at certain powers that are retained over some or all trust assets or income to derive how much taxable income gets taxed to a deemed owner versus how much gets taxed to a trust. And within this, we're going to make a split and a distinction between the trust's income and its corpus or principal, because it's that corpus or principal that often generates the income that an individual or trust is going to be taxed on under these grantor trust rules. So, with that being said, the core principle around which the grantor trust operates is deemed ownership of trust income and or corpus by some other taxpayer. And typically we get to that deemed ownership through another taxpayer who holds or retains certain rights or powers over a trust. We're not going to get into those specific powers outside of a brief look at some that apply to a beneficiary. Today, we're going to look at deeper dives throughout this series. But to start, many trusts have three parties. There's a grantor, that's the person who creates the trust. It's a trustee who has legal ownership of trust assets, and then a beneficiary who has beneficial ownership. Now, the grantor trust rules only look at two of those three parties, the grantor or the beneficiary, generally in that order, because we're going to start with Code Section 678B, which creates kind of a priority ordering rule where if the grantor trust rules or powers can apply to deem ownership in a grantor or a beneficiary over the same income or corpus, the grantor will win out. Now, why is that significant? Because the powers that apply to a grantor to determine deemed ownership are much broader. Those are found in Code Sections 671 through 677. Whereas for a beneficiary, we find very narrow deemed ownership rules under Code Section 678A1 and A2. Now, interestingly, A2 may apply sections 671 through 677 to a beneficiary, even though those only traditionally apply to a grantor, but that will only be in narrow circumstances. So where we're going to see that is in a situation where somebody retains certain powers over the trust itself. With a grantor, they're going to be a deemed owner if, to start, they're the named creator of a trust. That could be any one of interchangeable terms: grantor, settlor, trustor, trustmaker, even donor. And in addition to that, they have to make gratuitous transfers to the trust. In other words, they have to make transfers for less than fair market value. Now, that doesn't necessarily mean transfers that are subject to gift tax. It just means less than fair market value using somewhat different rules from what we looked at for gift tax. And we have to do that by comparing the exchange consideration received by the grantor, if any, which, under the grantor trust rules, could even include services rendered to the grantor by the trust itself. We won't get into some of those nuances, but for the time being, note that grantors can be individuals or entities. In most estate planning cases, we're going to be looking at individuals as grantors. Now, it could be that maybe a trust makes a gratuitous transfer to another trust, and if both trusts are grantor trust, or at least if Trust 1, the transferring trust, is a grantor trust, it may be the case that depending on the powers retained by Trust 1 over Trust 2, the individual grantor of Trust 1 may also be the deemed owner of Trust 2. Now, importantly, when we're looking at gratuitous transfers, these are generally going to be transfers during the grantor's life, not transfers at death. So typically, we're only going to see these deemed ownership rules applying to an inter vivos trust, i.e. a trust created by a grantor during life. It could be revocable or irrevocable. The grantor trust rules don't necessarily distinguish between the two types of trust, but instead, they say under Code Section 676 that a power to revoke will be one of many powers in all of those code sections which invokes the grantor trust rules and causes the grantor holding that power to revoke to be the deemed income tax owner. So in most cases, grantor is going to be the deemed owner of a revocable trust, and you're always going to have a grantor trust for a revocable trust. But when you have more than one grantor, that's typically only going to be tracked to what the grantor gratuitously transfers to that trust. Now, with that being said, we can have deemed ownership by a beneficiary as well. And this only applies, as we saw earlier, if a grantor themselves is not the deemed income tax owner, at least of the same portion of the trust. So there's a very narrow set of rules here where a beneficiary could be a deemed owner if either they retain certain powers to withdraw income and or corpus of a trust, or at some point they release or modify certain powers to withdraw income and or corpus of a trust, while after that release retaining rights that are described in sections 671 through 677. A lot of this reasoning comes from the case of Mallinckrodt v. Noonan out of the Ninth Circuit in 1945, under which a beneficiary's unrestricted right to withdraw trust income caused them to be taxed on that income regardless of whether or not they actually exercised that power to withdraw. So the terms of the trust said if that power wasn't exercised, that income would get allocated to corpus. And even then, the beneficiary was still taxed on that income allocated to corpus under this holding. And we now find that in modern day Code Section 678A1 and A2. Now, another piece of very, very important guidance in the grantor trust arena is Revenue Ruling 8513. We're going to discuss this ruling in greater detail in subsequent articles and videos. But for now, I think a lot of times it's easy to assume that based on our planning environment that if we have a grantor, for example, or any other deemed owner entering into transactions with the trust, that that individual deemed owner won't be taxed on the income generated by the consequences of that transaction. For example, any gain that's realized in the transaction itself. But the grantor trust rules don't expressly state that. All the grantor trust rules deal with is the allocation of trust's taxable income itself to a deemed owner. They don't expressly look at the income tax consequences of a deemed owner who's entering into transactions with the trust, which is really the core focus of this ruling, where if we start with a wholly grantor trust, then in a sense, that deemed owner is dealing with themselves in any transaction with the trust that might have income tax consequences, whether it results in gain realized by that deemed owner or gain realized by the trust itself, or even loss, or vice versa. So for that matter, any deemed owner of a wholly grantor trust, when transacting with that trust, essentially is dealing with themselves. So if they're selling assets, they're selling to themselves, and there can be no income tax consequences there. But to get there, we have to look at typically a wholly grantor trust, or at least without that, we have to trace that the deemed income tax ownership must apply to the exchange consideration to be received from the trust itself in the transaction. It's easiest to get there when we have a wholly grantor trust under which the retained rights of that deemed owner extends to all income and principal or corpus of the trust. So like I said, that's important from a theoretical perspective to understand that nuance, and we'll look at that a little bit more as we go through. Now, what happens if we don't have a grantor trust? And there's a special distinction here where there's a separate set of rules that we alluded to earlier that apply to determine the taxation of a trust under the highly compressed brackets brought up earlier. But in a sense, this isn't necessarily assignment, but I've given it that label. It could also be allocation, but it's not the same as distribution. And it's possible that through distribution, you could, in a sense, shift income tax in a non-grantor trust to beneficiaries, not necessarily the grantor themselves. And the way we get there is because if the grantor trust rules don't apply to some or all of a trust, then that taxable portion of the trust, that non-grantor portion of the trust, is taxed on income, but effectively it's only taxed on income that's not distributed by the trust during that tax year or with an election within 65 days of the end of that tax year, which in a sense means that even in a non-grantor trust, we could still shift some income by making income distributions to beneficiaries, depending on if we made those distributions under the rules of the trust and under state law governing the accounting income of trusts themselves. So in a sense, the way this works is we have gross income of a trust, and then the trust gets a deduction for distributable net income, or DNI. Then the beneficiaries receiving those distributions of income will receive a K1 from the trust. Keep in mind, all this only applies to a non-grantor trust. If we have a grantor trust, it overrides all of these rules, and it doesn't matter whether or not income is distributed, you're still going to have a deemed owner taxed on that income, whether a grantor or a beneficiary. But with that being said, those rules and sometimes the grantor trust rules operate off of that same chassis of looking at the fact that there are two sets of income rules that come into play when we're determining the general taxation of a trust. One is going to be our federal income tax laws, which really look at taxable income of a trust. That's income from any source. That could even include non-cash income in the form of phantom income, maybe from a pass-through entity. Contrast that with state trust accounting laws, which often look just to cash received as accounting income and may by default assign certain cash or non-cash types of considerations, maybe reinvestments and exchange consideration, to the corpus of the trust and not to the trust income from an accounting perspective. So when you're looking at distributions, you have to look at where they come from, starting with state trust accounting laws and then moving up to federal income tax laws as kind of the tail that wags the dog there. Now, with that being said, typically we're only going to worry about that distinction when we have a non-grantor trust. But when we look at the grantor trust rules, it may be the case that those rules just apply to one form of income, perhaps just the state trust accounting income in isolation. May also be that we look to just that income, or maybe we have to also bring into play what generates that income, which is the corpus, when we look at either taxable income or its more narrow counterpart, trust accounting income. Again, all those are nuances that will come up through this series. So stay tuned for subsequent videos and articles. I'll post videos here, but for the most part, I'd drive you to my newsletter, griffinbridgers.substack.com, where you can find the articles accompanying the videos. And if you have questions on the material, you can reach me at griffinbridgers.com. Now, note, I cannot answer all your questions, and I cannot provide tax or legal advice in response to your questions. But I thank you for joining me for this video, and I look forward to seeing you in the subsequent installments of this series.